If you've been trading the currency or Forex markets for as long as I have, which is around about 20 years, you'll remember when the euro was just under $1 to a euro, which we called parity at that time. And that was kind of when the euro started, when it was first introduced, just around about 2002. And the first movement of the euro over that period, the first number of years, 3 or 4 years, was up. And then we moved up further, all the way up to about 1.6. This is in 2008. And up and down between 1.5 and 1.2 for the next number of years. Then we dropped off again in 2015. And since then, it's now 2022. So another 7 years, we've been stuck in quite a tight range, speaking over the longer term, of course, between about 1.25 and 1.105. And right now we're at the bottom of the range. What I want to talk to you about today in this very quick video is about what you might call determinism, or perhaps a better term for it is predeterminism, in which people and philosophy and logic and even religion would say that things are determined, predetermined, that there's a predictable outcome for most things based on a variety of different factors. And there are different forms of determinism, like logical determinism, theological determinism, and physical determinism, and some others. And basically what this is saying is that the market or any other factor that we might be looking at in life has a predisposition to do certain things. And that's often used in trading when we look at things like various levels and moving averages and indicators, when they're oversold or overbought, or when we're at certain levels, that the market is very likely to react in certain ways. Now, there's a big problem with that, which you'll see as we go along. First of all, the biggest problem is that the market moves in quite large ranges over long periods of time. And within those ranges, we're not sure what's going to happen from a day-to-day or a week-to-week basis. So let's move from this monthly chart that we're looking at now to a weekly chart on the euro and have a look at the same picture, but from a weekly perspective. In this case, in this chart that we're looking at now, each one of these candles represents 1 month's movement going back about 20 years. So we'll switch to the weekly chart now. So we have here the weekly chart of the euro against the US dollar, the same currency, but now each candle represents 1 week's worth of movement rather than 1 month. And we go back to about 2016 on this chart. We can go back a little bit further. It'll take some time to load. But you can see that these ranges look rather much bigger than when we looked at this period over the monthly chart. And you can see we get some what look like much larger moves. And this is because we're kind of zooming in on the charts. And what we're trying to do with predicting where price movements occur and where turning points in the markets might happen is we look at these areas of probability, or what I mentioned earlier, predetermined points where the market is very likely to react in a specific way no matter what. And that's what technical analysis is essentially all about, which is what we do. So you can see on the weekly chart we've got what looks like a much bigger range, but it's the same range that we looked at on the monthly chart zoomed in. And our job is to try and predict where these turning points in the market is or are when we're trading technically, and to try and pick those turning points and to trade in the opposite direction. And that's essentially what technical trading does. We either trade with the trend and try and go with the trend. So, for example, here we've got a downtrend. We try and pick the tops and then sell. Every time it rallies up, we try and pick a turning point. Sometimes it's quite easy. You can see right in this case, there would be a trend line. I could just draw that in, actually. And this is over a couple of years, and you just draw a trend line in there. Whenever we get near the trend line after a brief rally, we try and sell the currency, and with an expectation that the trend will move down. And that's all very well with trend trading until the trend direction changes, of course. And often when the trend does change, there are periods of great volatility, like you can see here. This was the harbinger of a change in trend direction. And after all of this very erratic and volatile movement, the trend changed direction. We started to move in the opposite way. The problem with picking tops and bottoms, either with or against the trend, is that sometimes it's not that easy, and sometimes it's inaccurate. And sometimes if we're in a downtrend and we keep on picking tops and we're at a change in trend direction and we move into an uptrend, we'll be constantly picking tops of the movement, trying to sell and getting caught every time until we realize at some stage that the trend has changed and now we need to be picking bottoms. That's when we're trading in the direction of the trend. When you're trading against the direction of the trend, we're looking for, in a downtrend, we'd be looking for bottoms to trade up, like this downtrend. And in that case, you would perhaps call it channel trading. So a channel looks something like this. You draw a trend line at the top in a downtrend. Let me just neaten that up a little bit. I'm just going to put these in roughly. And if I just copy that line, we're looking for a parallel line running along the bottom. And if I just clone that and just drag this to the bottom of this trend, you can see we've got two parallel lines forming a downward channel, and we'd be looking to buy at the bottom of these moves for a movement back up to the top, and then looking, if you want to go with the trend, to pick a top and sell on the way down, or sell for an expectation of a move down, in that the market is predetermined to change direction at either the top of the channel or the bottom of the channel. Now, as I said, that's all very well, and it looks a little bit easier on a weekly or a monthly chart because these are long-term trends and they tend to be a bit more stable and predictable than shorter-term trends on shorter-term charts. Now, if we're trading off hourly charts, let's just remove that, and I'll switch over to an hourly chart now on the euro. When we look at the hourly chart, you can see that these moves are even more exaggerated and more predictable and more difficult to trade, because even though, and we're looking at the last period still, which is the euro's in an overall downtrend, but we can see it's not very easy to pick the bottoms or the tops, and the channels aren't as clear because we get much more erratic movements intraday than we do over days, weeks, and months. And so this is where we start to run into trouble, and we start to employ tactics and techniques and methods like using Fibonacci numbers for changing points in direction. We use moving averages, we use Bollinger Bands, horizontal lines, trend lines, all of those sorts of tools to try and pick tops and bottoms. Now, in certain market types, like we've had recently during the crisis in Ukraine, movements can go through those levels very quickly and very rapidly and very easily, and we can end up getting stopped out of trades multiple times in a row. In fact, we did see that in the early part of this month, and we ended up getting stopped out on some of these erratic movements when the market went unexpectedly against our direction. For example, in this overall downtrend, which you can see if we zoom out and you saw on the previous charts, in the overall downtrend, we sometimes get short squeezes like we have here, and the market rallies through our points of reversal. Now, if we put a trend line in here, and I'm just drawing these very roughly, we'd be looking to sell somewhere around here for a continuation of the trend down, but in fact, we got a dramatic move up. And then we'd be looking to sell again, perhaps at this horizontal line or at a Fibonacci level, somewhere up around where the cursor is right now, and we'd be stopped out multiple times in a row, which we in fact were at the beginning of this month. So what's the solution to all of this? Now, remember, we're talking about determinism, predictability, probability. They're all sort of linked when we're talking about trading. What we're trying to do is pick points on the chart where the market's likely to reverse. We don't know if the market is going to reverse or not, but we're picking areas to trade from where we think the market might reverse, and we employ tools like price action, candlestick formations, and candlestick patterns to try and help us determine whether the market is likely to reverse when we reach those levels. So we'd be looking for reversal candlesticks at some of the levels. And if I drew a Fibonacci in there, let me just quickly put one in, say from this move down to here, we'd be looking for candlestick reversal patterns at any of these levels, and perhaps a horizontal line we could put in there like this. So here, this sort of level there where these highs are, and look for reversal patterns. And sometimes we do get the reversal patterns, but the market continues to go against the direction which we've picked, despite having reversal patterns, and sometimes reversal patterns are indications that the markets are just hesitating or changing or thinking. And there's a sentiment that change needs to take place, but in the end, the pressure of the market moving one way or the other bursts the market through those price levels. So that becomes a bit risky and a bit tricky, particularly when you're dealing with hourly charts and larger stop levels, perhaps even daily charts with larger stop levels, meaning that you've got to take bigger risk in terms of the number of pips, and therefore you've got to reduce your position size because if you took a 100 pip stop loss, you can't do that at 2 or 3 or 4 or 5 to 1 leverage, because you'd be risking 2 or 3 or 4 or 5% of your account every time you're stopped out. So we don't want that. Granted that if the move does go in your favor, you're likely to gain much more than small intraday trade moves, but the risks are greater. You have to use smaller positions, and therefore the upside on the trades is reduced. So what do we do about all of this? Well, okay, I'm going to now switch to the 15-minute charts, which I've been trading now for the last number of weeks because of the volatility of the markets, and also because I can trade with tighter stops. If I'm watching the market, I can be nimble, I can be in and out of the market very quickly. I don't have to pick, and this is the important point about all of this, I don't have to pick turning points on the charts. I don't have to pick levels. I don't have to use indicators. I don't have to pick spots where I think the market might possibly change direction. I simply wait for the market to actually change direction and then trade with it and go with whatever the market's telling me. And in this case, I don't need to look at daily charts or weekly charts or even hourly charts. I can look solely at the 15-minute charts and trade whichever the way the market happens to be going through using very simple techniques on literally naked charts, apart from a few trend lines and a few horizontal lines. Let's look at the 15-minute charts quickly for me to illustrate this to you. So here we have a 15-minute chart of the euro against the US dollar. So we've zoomed right in. It's like putting a magnifying glass onto the chart. We've come down from a month to a week to a day to an hour. I don't think we looked at the daily charts, but you could. That would give a similar sort of analysis of what's going on. But we've zoomed in. It's like literally taking a macro lens onto the charts and saying, okay, what is happening right this moment, right now? What's actually happening in the market? Not what we think is going to happen, but what is actually happening. And we're moving away from the realm of prediction, of determinism, whatever you want to call it, probability. We're moving away from all of that, and we're moving to reaction rather than prediction. And it's a bit like sport, really. They'll teach you in most of the major sports that you need to react to the game conditions as they occur and not try to predict what the opposition. There is an element of that, of course, but not try to predict too much what the opposition is likely to do or the way the game is likely to be played out, but to react to the situation as it occurs. And that allows you to change your game plan constantly throughout the game. And it's very much the same with intraday trading, where you can do the same sort of thing, but with trading the markets. There is a drawback to intraday trading in that you've got to be very attentive, you've got to be alert, you've got to be nimble, you've got to be watching your charts whilst you're trading. You can't walk away like you can with hourly or daily chart trading. Set your levels and walk away and come back a bit later and do other things. There are short, intense bursts of trading activity which you need to employ during intraday trading. But once you're over for the day, once you're done, once you've had your number of hours of trading, mostly, if you do it properly, it'll be profitable. And then you've got the rest of the day. You don't have to hold trades overnight or over the weekends. You don't have to worry about missing potential opportunities. You don't have to worry about trying to analyze and predict what's going to happen. You just simply react to what's going to happen. So what we've been doing over the last number of weeks is trading these movements. Now, this 15-minute chart means that every one of these candles represents just a 15-minute period in the market. And I can just show you one example of a trade that we did actually take, and that's this one here. Let me just quickly, all I'm going to do right here is put on a trend line from this high. I'm not going to go through the entire system right now, but it's pretty simple. this trend line and horizontal line trading system. It's called a naked chart trading system. You'll see there are no indicators, there are no levels apart from trend lines, horizontal lines, and one or two other things that I look at. And there's a lot to do with money management and risk size and trade entries and exits and all that sort of thing. But the basics of it is to take a trade when the market reacts to what it wants to do. So in this case, we had a downward trend line, very short one. It's about 6 hours or 7 hours or so of trading activity. And we broke up through the trend line, and the trade was initiated the moment we broke through the trend line. We had a 20 pip stop loss on this trade and a 60 pip target. And within 1, 2, 3, 4, 5, 6, 7, 8 times 15, that's within 2 hours, we'd met the profit target and the trade was closed somewhere up around here, about 60 pips away from the entry point. So that's an example of non-predictive, non-deterministic, if you want to call it that, trading not based on anything to do with predictability, probability, determinism, anything like that. It's simply reacting to what the market is doing right now, not using lagging indicators. Remember, all indicators on charts are based on historic price action, what has actually happened before you look at the market. All the indicators show you what the price has been doing, not what it's going to do. And what we want to do is to trade with this sort of trading, in any case, if you're up to it and if you can tolerate the cut and the thrust of intraday trading. You're reacting to what the market is actually doing right at the moment. So every 15 minutes, you need to be on it and looking at those charts and making sure that you spot these opportunities and take hold of them. So in there, at the trend line break, out here at the target, okay, we missed a few pips. It went a little bit higher, but I think we might have missed out on 20 or 25 pips there. It did go a little bit higher. There are other ways of exiting the trades apart from having predetermined targets, of course. Things like using, once again, you'd have to go back into the realms of probability and predictability, but you'd be setting levels for the price to move to and assuming that the price will be drawn to those levels to set your targets. You could use a trailing stop loss. You could use various indicators like Bollinger Bands and moving averages and so on. But I just wanted to really highlight what the benefits of non-deterministic, non-probabilistic trading is all about, and how beneficial it can be if you're able to trade like this. And there are also psychological drawbacks to trading in this manner because you're watching the charts carefully. You can't walk away. You've got to watch painstakingly every movement and wonder if it's going to carry on, if it's going to reverse against you. You've got to be ready to pull the trigger when it happens. The very fact that you're actually watching the market move as it does. So once you're in a trade, you've got to be watching it. And the very fact that you're staring at it the whole time can create some psychological problems for people who are worried about, should we be getting out now? Should we wait? What's happening? The market's pulling back a bit. Oh dear, it might turn against me. And you're watching it ever so closely. And the turmoil of emotions can be overwhelming for some people. But if you get used to it, and with a bit of experience and a bit of time and a bit of determination to control those impulses, you can do it. I think anyone could possibly do it, unless you turn into a complete gibbering idiot, which is quite possible as well. It's happened to me. It's happened to loads of traders before. So just thought I'd point that out to you, talking about determinism, probability, and that sort of thing. And if you're interested in the philosophy of determinism, go and have a look. It's very interesting. And look up physical determinism, which is really what chart prediction based on technical analysis is. But there is also philosophical determinism. There's theological determinism. There's conditional determinism. There are 5 different types, I think. Very interesting to read. And it's an interesting philosophical debate which you can apply to trading the currency markets. Well, I hope you enjoy that. Have a great week ahead. It's Sunday afternoon, my time, and I'll be trading at 8 a.m. tomorrow morning in my trading room. So if you want to join, the links are on the page. Take care.